In emerging markets, capital struggles against severe geographic and temporal friction. Traditional banking infrastructure is often too rigid and too slow to capture this wealth or move it efficiently where it is needed. To bypass this system, users turn to global stablecoins like USDT and USDC. These digital assets offer instant, borderless liquidity. But that liquidity carries a systemic risk. These stablecoins operate entirely outside the regulatory perimeter of the local sovereign economy. This creates deposit flight. Local capital is drained from the emerging market and pooled into off-chain reserves by foreign token issuers. As these offshore reserves grow, the local credit market is starved of the funding capacity needed to issue loans and stimulate domestic growth. Project Sigma, or Sigma BankAI, counters this drain by deploying a trust-as-a-service model. It replaces stablecoins with tokenized deposits. By merging the cryptographic speed of a blockchain with the regulated, interest-bearing safety of commercial bank liabilities, capital remains onshore. The Sigma stack operates across 4 architectural tiers. It begins with Layer 1, the base asset. A tokenized deposit is a direct digital representation of commercial bank money. It is a programmable liability of the bank itself. On the left, stablecoins rely on opaque offshore databases with inherent audit risks. On the right, tokenized deposits anchor to a regulated local bank ledger. Linking to an onshore ledger triggers immediate eligibility for local deposit insurance. Beyond regulatory safety, this structural difference directly impacts the economics of yield. The interest generated by traditional stablecoin reserves flows upward, retained entirely by the central issuer. The Sigma framework reverses this flow. The interest-bearing yield generated by the tokenized deposit is passed downward, directly back to the local depositor. Paying yield to the depositor creates a direct economic incentive for users to keep their assets within the local banking system. When this capital stays on the bank's balance sheet, the bank maintains the reserve ratios required to fund local credit expansion. Replacing stablecoins with tokenized deposits aligns individual yield generation with broad local economic growth, repairing the sovereign balance sheet from the bottom up. Layer 2 is the identity gateway. This shifts the focus to the individual, mobile-first user. The primary onboarding hurdle in emerging markets is physical documentation. Traditional compliance protocols require paperwork that vulnerable populations simply do not have. Sigma BankAI deploys an AI-driven alternative credit scoring system to act as onboarding middleware. The central AI node processes non-traditional data streams, analyzing mobile phone usage patterns and utility payment histories to output a verified cryptographic token known as a Sigma ID. This Sigma ID satisfies regulatory compliance natively, removing the need for a physical bank branch visit. Securing this identity unlocks fractionalized deposits. Users can convert volatile local fiat into tokenized USD in micro amounts. These fractional units merge into a single hard currency token. Combining AI-driven identity verification with asset fractionalization allows undocumented populations to enter a regulated ecosystem and preserve their purchasing power against severe local inflation. Layer 3 consists of execution primitives. Here, smart contracts, which are self-executing programs stored on a blockchain, automate complex traditional banking services. The first primitive is atomic lending. Because tokenized deposits live on a ledger, they function as natively verifiable, instant collateral. Locking a deposit token into a smart contract instantly triggers a microloan in local fiat. Simultaneously, a portion of the earned interest is diverted into an insurance pool, creating yield-backed coverage against risk. Parametric insurance relies on smart contracts to execute automatic payouts based strictly on verifiable external data feeds, like local weather patterns or delayed shipping logs. For larger local enterprises, the protocol removes the friction of centralized foreign exchange desks. It does this through Sigma liquidity pools. These operate as automated market makers, or AMMs. An AMM automatically trades digital assets through liquidity pools, bypassing traditional matching. This circular pool shows local businesses trading tokenized grain directly against tokenized deposits, bypassing the FX desk entirely. This localized trade eliminates the high fees and settlement delays inherent to centralized currency exchange. By treating deposits as programmable building blocks, legacy banks can deploy these advanced financial tools with near zero marginal operational cost. Layer 4 is hardware settlement. This addresses physical limitations of the last mile in emerging markets. The critical infrastructure gap here is telecommunications. Spotty or non-existent internet connectivity reliably cripples standard digital payment systems. Sigma BankAI transforms standard smartphones into independent point-of-sale terminals using near-field communication. NFC lets devices share data directly when held close together. To execute payments without the internet, two mobile devices, isolated from any network, execute a direct cryptographic handshake. They transfer a key, generating a localized ledger entry. This transaction is safely cached locally. The moment either device regains an internet connection, that cached entry automatically pushes upward, syncing with the main bank ledger for final settlement. Cryptographic offline settlement decouples digital financial inclusion from the strict dependency on continuous telecommunications infrastructure. Operating together, these four technical layers form the complete Sigma Stack ecosystem. For onshore banking partners, Sigma acts as an operational accelerator that actively prevents deposit flight to offshore alternatives. Shifting the settlement infrastructure away from physical brick-and-mortar branches and onto mobile-first smart contracts sharply reduces overhead. This bar chart compares operating expenses. By utilizing smart contract settlement, local banks achieve up to an 80% reduction in the cost of servicing rural and underbanked areas. This digital migration also yields a highly valuable secondary benefit: deep data analytics. Sigma's AI engine actively maps digital transaction patterns that were previously entirely invisible in cash-only economies. Processing this new influx of behavioral data allows local banks to tighten risk management and improve the underwriting precision for their local credit books. Deploying next-generation financial infrastructure does not require bypassing the sovereign banking system. It requires upgrading its base layer to a programmable, tokenized architecture.